we're going to go and have a little look this mentor session about something I speak to a lot of traders about, and it's a really common thing that people often sort of say, and so I want to try and illustrate this a little bit today. The point of this is, don't make excuses. I find that too often people have an idea, they get to a point where they might want to execute this idea, and then they make excuses. Reasons why it won't work. Reasons why maybe they should do something different. Maybe they should do this. Maybe they should do that. And what you're doing, and I've done streams similar to this in the past, is what you're doing is you're never giving yourself the chance to actually execute with any kind of conviction. And ultimately, conviction is important. Yes, you might get it wrong. Yes, the trade might go against you. But at least if you go at it with some conviction and some kind of belief of what's going to happen, or at least idea and expectation of what's going to happen, you're fine. But if you get to a point where you want to enter and then you sort of talk up why it won't work, why it will work, etc., etc., this then creates a great deal of problems. So, let's go and have a little look at what I mean by this. Basically, a lot of the time, it's having a plan and then breaking it. It's having an idea of what you want to do. You want to buy here, you want to sell here, and then when you get to that point, it's then finding any reason to not do it, or once you're in the trade itself, finding any reason to get out of the trade. And this is just really a case for most people, I think, of either trying to protect themselves, fear that the trade won't work, and essentially, as I say, making an excuse to give something up. You know, you're not giving something the chance to work because you essentially are looking at it from the point of view of this needs to work immediately. The moment I click is the moment it will work. And let's face it, that either falls on one of two things. Either arrogance, that you control the market and when you click it will work, or ignorance of the fact that the market is going to move in its own way, and what you're looking to try and do is interpret the way it's moving, and then as long as that lines up with the way you expect it to move, if a certain type of move is going to play out, then you take the trade. And that's the kind of thing that you need to be thinking about here. So you can't just make excuses of, oh, it didn't quite look right. The other thing, or the flip of that, is also to ask yourself, well, what looked wrong about that trade? You were about to take the trade on. Did it have what you wanted to see? Was there any reason that it was actually wrong? The other way that people make excuses as well is finding reasons to justify exits. And often this is a case of trying to protect themselves from too big a loss, in inverted commas, i.e. a loss that they don't really want to take because the monetary point of it is larger than they would really like. Now, you have to look at that and say to yourself, well, you're not going to get a cheap exit. You know, you're not going to get away with this by giving yourself a tighter stop and, well, hoping that means that it's not going to cost you very much if it goes wrong. Yeah, it won't cost you very much, but the chance of it going wrong is also very high. And that's where you get yourself in trouble. That finding differences in trades, tiny, minute, nuanced differences, to justify or to make an excuse as to why a stop should be placed in a certain place, is either a case of justifying the trade after you've entered, post-entry rationalisation, or just simply a case of trying to find an excuse as to why you can have a cheap stop. The one thing that I think is really important with this type of thing is also when you look back at these things, when you look back at trades where you've kind of justified it and you said, oh, I should put my stop here because of this, and this. Look back at it, and if that trade's not worked, so let's say you place yourself a tight stop, as people like to call it, which is a very arbitrary point. Place yourself a tight stop, and the trade ultimately doesn't work. So if you placed your stop anywhere else, it still would have got stopped out. This doesn't necessarily justify the decision. It doesn't make that reasoning right just because the trade still went wrong. If it went wrong and you got stopped out where you were wrong, then fine, the trade's not worked. But just because you've saved some money by giving yourself a stop that is not ideally placed doesn't justify the decision to place your stop in that type of way. So let's go and have a little look at an example. There's a couple that I've got here. So first up, indecision. Looking for a move down, looking for a move down through the previous day's value. And we'll come back to revisit what happens afterwards as well. But the whole initial part of this trade is to be looking for an entry around 77. That's the top of yesterday's value. If you get through there, this is then the opportunity for the further move towards the downside. Now, I was speaking to someone earlier who was looking for this trade through 77, and you've got this move down. But he said, oh, there was loads of indecision there. And that price action suggested there was a lot of absorption, negative delta was high, but we didn't move down. Yeah, absolutely. So you're getting absorption because people are selling. That creates negative delta. So there are sellers. Now, that is what you're likely to get at a previous value area high. People are going to react to it and look to buy from there. So they will absorb some of the selling. So you've got to ask yourself, well, yes, there is indecision. Of course there is, because some people want to sell because they think it's going to go down, and some people want to buy because they think it's going to go up. What you're looking for is you've got to go into this point and say to yourself, right, I think it's going to go down. If I can see somebody absorbing, then fine. I'm going to wait for them to disappear and then sell it. Rather than look at that as indecision. Yes, it's indecision, but you have to be one side of that decision. You have to make your decision on what you're looking to see. If the absorption doesn't disappear, you don't take the trade. But no market is going to get to a point and flag to you, oh look, this is exactly what you were looking for, do it now. So what you're waiting for then is, if you think there's a bit of absorption there, and we'll go and investigate this. So this is the move down then. Looking to get below 77, which gets inside yesterday's value area, for then a drop further towards the downside. And at this point in time, it's not flying down, no. But I would hardly suggest that there's a great deal of absorption going on either. If you think that 77 is the point where you want to be interested, that's fine. So you're waiting for it to get there. The fact that it's not rushed there and it's charging through there doesn't really matter. You need to make a decision when we get there. In terms of negative delta at this point is about 1200 negative in Bund, so it's hardly significant. Yeah, that's the kind of thing that you could see flip on one trade when someone sells a 1200 lot into a bid. Yeah, that would be it. So yeah, there's indecision in the sense that nobody's directly making a decision, but you've got to look at this, and if this is the point where you want to sell, then you've got to say to yourself, right, I want to sell this. I'm looking for somebody to get out of the way at 77, and we're going to sell this. So you're taking that indecision, you're turning it into some kind of positive action. Whereas if you look at the market and go, oh, that was indecision, well, you're always going to think, that's indecision. And the only time that it's a clear decision, it's going to go straight through the point, so you won't get the chance to make your own decision because the decision gets made for you. Essentially, you need a market to be slightly indecisive for you to be able to take a trade on. Otherwise, the market is decisive and it trades 79, 78, 77, 76, 75, and you're sitting there thinking, well, what do I do now? Because the decision got made. And yes, it was very decisive, and equally, you're not in the trade. So you're looking for it down towards 77 now. At this point, this is the first real touch of 77. 2 lots has traded down, so not a great deal of absorption here at this point in time. Trades straight through, 50 lots, it's gone through 77. If you want to sell this, that was as decisive as you want. The bid disappeared, trade straight through, you can sell it now. And that's the bit that you're after. So whilst it does look indecisive, don't allow this to change your view of a trade, your view of what's going to happen. If you want to sell this, you still want to sell this. Just because no one's made a decision right now, you're waiting for that little point from the order flow that says now a decision has been made. It only took 2 minutes and it traded above 77. As soon as it traded 77, 1 minute and we were through it, and almost no trade there. So don't look at a market being indecisive as a reason to sort of deem that you need to be indecisive as well. You've decided what you want to see. All you're waiting for is to see what you want to see. Now the second bit was then, after seeing that, a trade put on and a stop placed. And this I felt was a prime example of finding reason to justify a trade or making excuses why a trade is going to work. And the point that I want to make here is you can't chop and change your reasoning to take trades on. So if we go and look at this, what I've got here, this is the trade that we just looked at, the short at 77, 76. This was the trade that was taken. What we'd got at this point was initial balance and a breakdown in the M print. So that's just here. What we saw yesterday was the same thing. Similar size initial balance, breakdown in the M print, continuation, which ultimately is what we're looking for here. Continuation down towards yesterday's VPOG, which you can see on this trade over here is down here. So, trade's taken on, but the stop is placed around here. And the question that I had for this person was, well, why should it be there? When looking at exactly the same type of trade yesterday, if you place your stop inside the initial balance, which was a trade that was discussed yesterday and that he took yesterday, or at least later on took, well, it's essentially the same trade. The push out of the IB, the short below the IB, using the initial balance as your resistance to play the move down, is how you would try and take that trade on the day. It's a replicable trade situation that you could take on. But instead the excuse was made was, well, value's different. So the previous day's value, yes, we were trading outside of value, you'd pushed through value and this was a move lower. But the reason for 79 was that value was different yesterday. So rather than looking at it from the perspective of the market has now just sold off, it's started to drop, it's consolidated a little bit and you've got a short. You then put the stop below the initial balance, which if this is going to become a directional day, you should not go back inside the initial balance. So that's a very common type method to place a stop. So it's not me just trying to find a reason to explain this. It's a very, very common method of how you place a stop. So the whole idea of this trade, and this is my point on, just because it worked in terms of saving money doesn't justify the trade. This taken on here, and if you're going to go and look at other reasons, based on the reasoning to take this trade, that you've got the falling delta, there's no falling delta here, so there should be no reason to even be short. But the trade works because you're getting the breakout of the IB. Same type of thing here, you're getting the break of the IB. The break of the IB facilitates this move down. Value, you're moving inside it, but you've got 2 points here. You're inside value and you've just broken the IB. That's your area of resistance, so you need to get your stop up above there. By placing a stop at 79, it has meant that the trade has not cost as much. Sell 76 out of 79. The trade doesn't work and it comes back inside the initial balance. But at this point, you don't know that. At this point, you're looking for a replica of yesterday. And so your stop should be up here. If you place your stop up here, then yes, you're wrong today. And that's fine. Because you're wrong today and it cost you maybe 6 ticks. Yesterday, same trade, you weren't wrong and it gave you 20, 30 plus ticks. So over time, the trade works. The trade makes sense. But by justifying a trade using another reason for the trade, which ultimately this is your reason for it to go down, And so you then, having been given the opportunity to play to the downside, you're using the very first excuse to get out of this trade. And this is what I mean by excuses. Don't bring excuses in to justify why you're placing tight stops. Don't bring excuses in to inhibit your decision making process. Your decisions need to get made and you need to look at them and say to yourself, right, this is the decision I'm looking for. I expect it to happen and play out from here. I'm going to execute it now. Know what you're looking for when you're taking a trade on. When we trade like this, that initial balance low was that was the point where you got the beginning of that breakdown. That was your indication that you needed to place your stop up above that.
If you find this video interesting, if you want to go deep into the Axia training method and how our trading team of 7-figure traders develop setups and strategies and how they learn to build the most profitable trades across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the Vel concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.